In this video, we're going to look at Omega Healthcare, and this is a REIT, and what I do in my videos is I run my discounted cash flow model to figure out the value of the stock and also look at the financial ratios of the company and compare them to similar companies. So let's get started with the model. This company has a market cap of $6.94 billion. And let's see what they're trading at. They're trading at 30.57, so that's one share of stock, cost roughly $30. And then we're going to pull the free cash flows. And this is the best way to value a company is you estimate the future free cash flows and discount that number back to today's value. Free cash flow is the cash that's remaining after operating a business minus large capital expenditures. Now I'm going to pull the net income, which is the profit and loss on the income statement. And I usually pull 4 years to put into the model. And now I'm going to pull the revenue, which are the sales. And we'll take a quick look at the numbers. The numbers look pretty consistent, so it should be pretty easy to get a value for this company. That's all you need is consistent positive numbers. Let's look at a capital structure so we can figure out the discount rate to apply to the future cash flows. So they pay $208 million of interest on their debt. And let's find out how much debt they have. We'll go to the balance sheet. Go to liability section. No current debt. Long-term debt of $5.1 billion. That's debt due after 12 months. They pay 4% interest on the debt. That's their cost of debt. Now let's get the beta so we can figure out the cost of equity. And they have a pretty low beta, 0.84. That means the stock moves less than the market, so it's not too volatile. So let's look at the balance sheet, get their current assets. That's $458 million. We're going to need that when we look at the ratios later on. And now I need their current liabilities. These are debts and payables that are due within 12 months. And their equity, which is $4.1 billion. That's assets minus liabilities. And now we're going to get their EBIT, earnings before interest and taxes. That's called operating income on the income statement. That's how much money the company makes through its regular operational business. Let's look at the capital structure of the company. The cost of debt is 4.1%, and they have 55% of debt in their capital structure. The cost of equity is 8.8%, and they have 45% equity in their capital structure. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity. And their WACC is 6.2%, and that's what we're going to discount the future cash flows by. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of $6.5 billion. We divide that by 227 million shares, and we get a calculated intrinsic stock price of $29. It's trading at $31, so it's trading at a premium, a 6% premium. So it's a sell according to the model, but it's really close. Let's see what Simply Wall Street values the company at. They're saying the stock is worth $65, so they're saying it's a really good value to buy it now. Let's look at the historical stock price. It was trading about $45 a few months ago, and it seems like it's been trading well over $30 for a while. It dropped a bit when coronavirus. It's come up and down a couple times. So it's sitting around $30. So let's also look at their financial ratios to get some more information. They have a PE ratio of 20.3. That's price to stock over earnings per share. And they have a price to sales ratio of 7.5. That's price to stock over sales per share. They have a good price to book of 1.7. That's price to stock over book value per share. They have a good current ratio of 1.5, so they can easily cover their current liabilities. A low ROE of 8%. That's income over equity. Interest coverage ratio of 2.7, so they can cover their interest payments almost 3 times. Best way to look at ratios is to compare them to similar companies. I did a video on national health investors, and they're in the same industry as Omega. And look at the ratios side by side. NHI is a better price to earnings. OHI is better in price to sales and price to book. NHI is better in current ratio, ROE, and debt. And Omega is bigger in market cap. So some investors look at funds from operations as a way to value REITs instead of the traditional PE, price to sales and price to book ratios. Funds from operations takes the net income and adds back amortization and depreciation, then minuses out any gains on sale of real estate. And if you break down the funds from operations on a per share basis, NHI is almost double as much as Omega. The higher the FFO ratio, the better. So NHI wins in that categories, but everybody has their own way to look at companies, their own analysis. So let me know what you think of the video. Thanks for watching.